What is a CFD? Contracts for difference were invented by city bankers in the early 1990s as a way of funding bids for corporate takeovers. But CFDs are an increasingly popular way for private individuals to trade. Put simply, a CFD is an agreement to exchange the difference in value of a particular financial product between the time at which the contract is opened and the time at which it is closed. But CFDs have the added benefit of being traded on margin and, unlike shares, are exempt of stamp duty. In fact, brokerage using CFDs is much cheaper than buying shares. They're rapidly taking on traditional share trading as they offer a way to trade in a flexible and cost-efficient way. CFDs allow you to trade on a huge range of markets without physically purchasing the underlying instrument, and so make a potential profit if the market goes down as well as up. Like a spread bet, you're quoted a two-way price, a bid and an offer. For example, BP 468, 468.5. So you buy or offer if you think the market is rising, or sell, bid, if you expect it to fall. And not just on quoted companies, but commodities like oil or gold, indices like the FTSE 100 or the Dow Jones, or foreign exchange prices like the US dollar versus sterling or euro. Another reason traders like CFDs is they're much less complex than options and warrants, because a CFD price directly mirrors the price and liquidity of the underlying market. So you trade, say, on the price of crude oil without actually purchasing the barrels, or on the price of a stock without owning the share. Like share trading, you deal at the cash price of the share and pay a commission, which is calculated as a percentage of the value of the transaction. But unlike shares, you don't have to pay for the full value of the position you've opened. Instead, you put up a deposit or margin. Now, this will typically be from 5 to 10% for shares and usually 1% for indices, which means you can trade up to 20 times your initial capital. In this respect, it's similar to spread betting. When you close your position, the difference between your opening contract value and your closing contract value is realised, your profit or loss. Be aware, though, there is an overnight interest cost on an open long CFD position, typically 2% above LIBOR, the interbank lending rate. More on this in part 3. Go to part 2 for more on CFD trading.